Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And yes, it's August. It's very firmly August, but this is a big week, Scarlett.
Yeah, you have Jay Powell speaking on Friday, but before then, we've got European leaders and Ukraine's president meeting with President Donald Trump.
Absolutely. And we have retail earnings to look forward to, so a lot to digest, but let's get to the biggest stories right now in the more than $17 trillion global ETF industry. And we start with Vanguard filing plans for its priciest ETFs yet as it beefs up its active lineup. In just a moment, we'll speak to the firm's head of active equity product, Ryan Barksdale.
Plus, as AI demand soars, we speak to Paul Baiocchi about his ETF focused on electrification and big bets without the big losses. We look at a group of new leverage funds that look to take away much of the risk. Now, Eric Balchunas is off for the week. It is August, so Katie is taking a look at flows. What do you have for us?
Can't believe he is not here once again. So let me try my best to do my Eric Balchunas impression. You take a look at where money was flowing in the week that was just past. The Qs up top with a $5 billion inflow for the week. You would say, okay, people feel great about tech, but we'll talk a little bit more about that in just a bit. You can see VU picking up another $3 billion here. Ether, which we've been talking about, that is BlackRock's Ether fund, seeing continued demand, taking in another $2.3 billion, just been on fire this summer. So those are the inflows. Let's take a look at the outflows. And this is where things get a little bit interesting. You do have SPY up top losing about $3 billion. We can never read too much into what's going on with SPY since it's such a trading tool at this point. But then you see XLC, not a fund we often see up there. That is a sector-specific ETF. It focuses on communications, and that's a lot of tech names that are just disguised as communication funds. Anyway, it lost about $2.6 billion. And then you also had IGV losing money as well. So not a clean read on tech. We'll continue to monitor that story. But let's take a look at the leaderboard when it comes to issuers. We haven't thrown up this chart in a while, and it's a really great one. This coming from our friends over at Bloomberg Intelligence. They looked at BlackRock and Vanguard, and then BlackRock X Crypto. We're talking about IBIT, Ether, which have been big successes for BlackRock. If you remove the influence of those funds from their AUM, you can see that Vanguard has just about caught up to BlackRock when it comes to overall ETF assets. But you add them back in, that is the white line there, Scarlett. You can see that the influence of crypto has really let BlackRock keep their lead in this industry.
All right, Katie, great stuff. Let's talk about one of those issuers right now, because joining us this morning, or this afternoon, I should say, is Ryan Barksdale. He is head of active equity product at Vanguard. Ryan, it's great to see you. And Katie showed us kind of the leaderboard and where Vanguard stands. But what you're doing right now is launching active equity ETFs, which, I mean, Vanguard is the king of cheap beta. So isn't this kind of going against what Jack Bogle stood for in every way?
We don't think so. And it's great to be here, so thank you. If you go back 50 years, we just celebrated our 50-year anniversary just this spring. And if you go back to the beginning, we started with active management. And if you look at active management as a portion of Vanguard's assets, it's roughly $2 trillion of the almost $11 trillion in assets that we have. And we're really excited about the combination. Wellington's been a partner since the very beginning, 50 years ago. We think it offers investors access to a world-class investment manager, allows investors to use each strategy, in and of itself or complementary in a portfolio, and we're going to deliver it in an ETF wrapper, which Vanguard has 25 years of experience. So low cost, transparent, tax efficient. We're quite familiar with the benefits and excited.
Yeah, there's several important firsts in here. Of course, this is the first time that you've brought that Wellington partnership to the ETF wrapper. These are also your first really fundamentals-based active equity ETFs, stock picking ETFs, if you will, the Vanguard Wellington Dividend Growth Active ETF. You also have just a plain old growth active ETF and then a value active ETF. So I guess my question is, given that you do have this active footprint, you do have this partnership with Wellington dating back to the very beginning, why now? Why did it take so long to come here?
We see it as a natural extension and next step. So you all would have been familiar with what we've done on the fixed income side. We've launched several active ETFs on the fixed income side as well as index side too. Just a few years back, we launched equity factor ETFs. So it just feels like a natural next step and extension of not only our active ETF lineup, but also our partnership with Wellington, which, to your point, Katie, we've had for over 50 years, and we want to continue to meet investors where they're at. Our investors have a wide range of preferences and needs, and we have significant assets in our active strategies, and this gives us a chance to reach those investors in a preferred vehicle.
Let's talk about cost tiers because that definitely turned a lot of eyeballs. So the expense ratios on these funds, 40 basis points, 35 basis points, and 30 basis points. Now for active equity ETFs in the grand scheme of life, that's very, very low. For Vanguard, that's relatively high. I believe coming into today, your costliest ETF was charging 30 basis points. So how did you land on these fees?
It's always a balancing act, and it involves several variables. But what I will say first, one of those variables is, are these costs, how do they compare relative to other options in the space? And we believe they're, quite attractively priced today. And even if you reflect on our active equity mutual fund lineup that we've developed over the last several decades, close to 100% of our active equity mutual funds are in the lowest quintile. So again, we look at the pricing, which you would expect us to spend a lot of time on as a component of the product launch, and we feel like they're giving investors a really fair deal for the expertise that they're getting from Wellington.
Yeah, to Katie's point, the average fee of U.S. listed active equity ETFs is about 0.76%. So this is well below that. Are you going to be trying to lower the fee going forward? Because that's something that Vanguard has been doing with existing funds.
Yeah, as you know, Scarlett, that's been the case for the last 50 years, and I would suspect it's going to be continue to be the case for the next many decades to come. Our goal is to give our investors the best chance for investment success, and a lot of that has to do with the cost of investing, right? So we believe very much so in combining the talent of Wellington in this case with a low-cost product, and to the extent that we can continue to lower expense ratios over time, we will.
How do you anticipate these funds fitting into someone's portfolio? Do they supplement a low-cost S&P 500 index fund? I mean, where do you see it fitting in? Are they a replacement?
They can be both, potentially. We serve 50 million investors across the globe, and as you could imagine, there are a wide variety of preferences and needs for investors at the portfolio level. We're going to launch strategies that we believe can stand on their own in terms of an investor preference, but can also complement what investors already have. So, we get the question a lot, index versus active. We don't necessarily think that's the right question at this point. I think investors of all shapes and sizes have blended both strategies together for a very long time. And again, the ETF wrapper is allowing them to do so even more into the future.
So Ryan, your title is Head of Active Equity Product, which implies that you have a world outside of ETFs. Scarlett and I just live in ETFs, so it's exciting to talk to someone such as yourself. And with that in mind, when you're taking a look at the different products that you have available to launch your different active equity strategies in, what wouldn't work in the ETF wrapper?
It's a fair question. We look at, so maybe I'll take a step back. So Vanguard has 20 plus partners that we work with in addition to Wellington across 60 plus strategies, largely in the mutual fund format. So we have a really strong place to start from. I mean, what's important for us as we launch any new product is that when we look out 3, 5, 10 years in advance, we think there's an enduring investment merit. We also want to make sure that clients can use them, to the prior question. Clients have a clear use case in a portfolio context, and they're showing some demand for the product. And we want to be able to price them competitively, too. So those are the questions we ask ourselves to launch product. We have a very disciplined approach at Vanguard, as you well know. So there are a number of strategies that fall in and out of those questions all the time. And frankly, our thoughts and answers to those questions can evolve over time, too, as needs and preferences evolve from our clients. Again, we're serving 50 million clients, so there's no doubt that needs and preferences will look different 5, 10 years in advance than they did 5, 10 years ago, and we need to respond.
I want to stay in that theme of evolution, because earlier you said you want to meet investors where they are, and where they are is demanding a lot of crypto exposure as well as single stock ETFs or leveraged ETFs. Would you consider branching out into those products in the near term?
Well, we want to continue to innovate. Innovation is going to come in a lot of shapes and sizes, right? What we don't want to do is just respond to the current fad of today. Right?
Is crypto a fad?
We want to make sure it's an enduring investment theme over time. So, to the extent that our clients will continue to demand will continue to demand and express their needs and preferences, then we want to respond, right? So we'll see.
So does that sound like you're a maybe when it comes to single stock ETFs? I asked because we had Travis Spence from JP Morgan Asset Management on the program a couple weeks ago, and he was pretty clear that no, that's not a space where JP Morgan is looking to play. I mean, as the head of active equity product, would you look at single stocks as a category you might be interested in?
No.
No. All right.
Yeah, I think,
another definitive no.
When we reflect on our investment principles, even beyond how we design product, investment principles, one of the key investment principles there is balance, and inherent in balance is diversification. And so, while we can consider, partnering with a Wellington who manages relatively concentrated portfolios and then the stock picker type, we still want to make sure it's an enduring, balanced, and diversified strategy for our end clients over time.
All right, Ryan, really great to get some time with you on this busy day. That is Ryan Barksdale of Vanguard. Now, coming up, speaking of single stock ETFs, offering big bets without the big losses, we'll discuss the new single stock leverage fund with potentially much less risks next. Boy, this is ETF IQ on Bloomberg.
It's Monday.
Could not get the words out. It's Monday. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with the funky funds. We're talking about single stock ETFs. We know that they have been very popular among investors. They're also very popular among issuers as well. You're taking a look at the share of new launches. And in 2025, single stock ETFs have been 20% of the new funds that have come to market. These only started to exist in 2022, so really explosive growth, and I think you can bet that it's going to continue. Let's also talk about dividends, which I promise is exciting because we're talking about dodging dividend taxes. This strategy launched for S&P 500 type funds in XDiv. I believe that was in July, and now the strategy arriving in the fixed income wrapper as well. Basically, this type of fund, it invests in other ETFs and then sells them before their ex-dividend date, quickly rotates into a similar type of exposure, and then undoes it and basically dodges dividend taxes. It's really interesting, and it'll be fascinating to see how these are received. But let's go back to single stock ETFs. We've talked about buffer ETFs a lot on this program, and now you see the combination, these single stock buffer leveraged funds from leverage shares launching, and it's interesting to think about who the audience for these is.
This is a really good point. And of course, they're all focused on the usual suspects, right? Tesla, Coinbase, Strategy, and Nvidia. Let's talk about this more with Bloomberg's Vildana Hajric, who's been writing a story on this. So this is a buffer strategy, but applied to a single stock rather than an index. And of course, I mentioned the most actively traded names as the focus point.
Right, of course. So we have a suite 5 new funds from Leverage Shares, who is a single stock issuer. They're not exactly totally 100% buffer, because when we think of buffer, it protects to the downside. This sort of protects to the downside. So you're buying a single stock name like Nvidia or Tesla, or MicroStrategy, of course, is one of the options. Some of the most highly traded, most volatile stocks. And you're getting 2x on the upside up to a cap. The downside with a traditional single stock ETF would also be 2x. This is 1x to the downside. So it's sort of buffered. You're basically just losing, like if Tesla loses 10% in 1 month, you'd also lose 10% versus a traditional single stock ETF would lose a lot more, obviously.
Who is this for? Because when we talk about this single stock ETF audience, we tend to talk about retail traders, individual investors who like to have some risk in their portfolio. They like to take interesting, risky bets. You're taking away the risk from this product, so who does that leave?
Well, you're still taking some risk, right?
True.
Like with the example I just gave, if Tesla falls 10%, you're still going to lose 10%, but 2x to the upside up to a cap. It's still for somebody who is looking for some leverage, a little bit more adrenaline than just buying Tesla, for instance. So I think it's for maybe somebody who is looking for some risk, some amped up exposure, but isn't all the way into buying something that's purely 2x.
Katie.
Yeah, 1 foot in, but not both.
I do appreciate the innovation, though. Like, I think that's why this is an important story, because as you mentioned, there's so many single stock ETFs, so many, and issuers are constantly coming out with them, and the issuers are needing to find ways to make this new and fresh.
All right, Vildana, always a pleasure. Thank you so much. Bloomberg's cross-asset reporter Vildana Hajric. I just want to mention right now that we've got leaders from Europe arriving at the White House. You are seeing, of course, the driveway in front of the White House, and we are awaiting the arrival of the European delegation, which includes the European Commission President Ursula von der Leyen, the NATO Secretary General Mark Rutte, Finland's President Alexander Stubb, the German Chancellor, the UK Prime Minister, the French President Emmanuel Macron, and, of course, Italy's Prime Minister Giorgia Meloni. We will bring you visuals of it when they arrive. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. In the hot seat this Monday, we have the ALPS Electrification Infrastructure ETF. Love the ticker. It's very cute. ELFI. And this fund is all about finding companies that are part of and positioned to benefit from the electrification process. The minimum market cap here is $5 billion, so think mid caps, large caps, the list goes on. This ETF only launched in April, so it's relatively new, and already it has about $60 million in assets, so not bad. It's actually a passive fund. It has a relatively high fee for that category, about 50 basis points, but still managing to catch some eyeballs. Let's take a look at some of the holdings. This is an interesting fund for many reasons. One of them is that it really doesn't have any tech names. Its top holdings are Generac, Cognex, Talon, Comfort Systems, not exactly household names, but the bet here is that, of course, electrification only going to become more important. Let's take a look at the performance so far. Again, it only came to the market in April, so not a huge track record here, but you can see it's doing well so far. We have black boxes here, and I'm not sure why. So let's take a look at the lines. You can see we have ELFI in white. That is your white line. It's up about 35% on a total return basis. We have it compared to SPY in orange. You can see that it's outperforming SPY, not faring as well against the Qs. The Qs are up somewhere closer to 40%. But again, this isn't necessarily a tech fund, Scarlett, though it feels tech adjacent.
I think that's a really good way of putting it, Katie. So joining us now to talk more about ELFI is Paul Baiocchi. He is head of fund strategy at SS&C ALPS Advisors. Paul, great to speak with you. And as Katie pointed out, this fund pulls from a lot of different sectors, 5 sectors, 18 industry groups, but no actual exposure to the tech sector itself. So talk a little bit about what that gives investors in terms of exposure to growth versus value.
Well, I think the tech sector is responsible for a lot of the increase in electricity demand that is being forecasted to take place over the course of the next 5 years and into the coming decades. And so when you think about the hyperscalers, and we just got through a round of earnings where some of these companies are ratcheting up their CapEx guidance, 75 billion here, 80 billion there, those hyperscalers are investing in a lot of the infrastructure that the companies in ELFI are providing. And so Mark McLean at Ladenburg Thalmann, who built this index and has spent years in utility finance, really thought about the holistic electrification theme and really who are the companies that stand to benefit without drawing a line in the sand between natural gas or solar, renewable energy versus some of the incumbent energy sources. And when you look through ELFI, you'll notice it's equally weighted. So it's got balance to the exposure that it provides. But critically, the design of ELFI's index and the design of ELFI in terms of the exposure it provides is to ensure that these are the companies that stand to benefit from the massive investment that's taking place from the hyperscalers, from utilities companies, and gives you textured exposure to all of the companies that are playing a part in building the electrification infrastructure necessary to support not just AI data center growth. You talked about AI adjacent or tech adjacent. I would argue it is. And last time I was on the show, we talked about AMLP as kind of an AI adjacency play. In many ways, ELFI does benefit from AI and the massive spending there, but there's a lot of trends that are converging to drive electricity demand higher.
It's really, there's a number of ways to take this, Paul. It's very interesting. I love the phrase textured exposure. I haven't heard that before. And it gets to what I was thinking about, that, you know, you take a look at your holdings, your different allocations, you're really coming at the electrification theme from a lot of different angles. I believe you have 5 different sectors in here, even more industry groups. So it's almost like diversification within a theme when you think about the different types of business models that you're targeting here.
Yeah, Katie, and I'm sure a lot of people in the ETF world hear thematic ETF and they kind of roll their eyes, because we went through a phase where people were launching thematic ETFs at the height of some of this mania. And what's interesting about ALPS is, as you pointed out, 40% of the portfolio is in utilities. That creates a very defensive orientation within the portfolio by nature, but it's filled out with industrials, materials, even technology names, as well as some of the companies that have been at the heart of this electrification renaissance. And when you see some of these numbers, I mean, Bloomberg NEF is talking about upwards of 100 billion annual investment in the grid itself. You're talking about increasing electricity intensity in every dollar of GDP. You're talking about electricity demand growth that we haven't seen since the 1960s. So it really is beyond AI, a convergence of policy, reshoring, consumer level trends, switching from ICEs to EVs, switching from your typical heating unit to heat pumps. And you go through it, and the numbers really jump out at you.
Yeah, it's pretty clear that this goes beyond exposure to AI, but to also electricity and the process that's going through. Why limit it to mid and large cap companies? Smaller companies could potentially be M&A targets, could be in play.
Well, I think what we've seen in this cycle, and we saw with our renewable energy ETF ACEs, is that the punishing impact that rising interest rates have on pre-profitability companies has been very different than prior cycles. And so at $5 billion minimum market cap, you at least ensure some of these companies have some scale, they're established, and it insulates you somewhat from some of the pitfalls that come with investing in thematic portfolios that are trying to buy lottery tickets or trying to buy pre-profitability companies that haven't necessarily grown into the marketplace that they're trying to compete in. And this trend, electrification, is playing out now. It's going to play out over the next 5 years.
Have to leave it there. Really appreciate your time. That is Paul Baiocchi of SS&C ALPS Advisors. We do see some of the world leaders arriving at the White House. Of course, a discussion between European allies and Zelensky coming up with Donald Trump soon. This is Bloomberg.